Let's see an example here, dive through it and make it real, right? So washer company makes the following two payments in year one. Well, we made two payments. We paid on January 31st, 48,000, and then we paid July 31st, 36,000. Now we are taking into account how many months these costs essentially existed. So we made this at the end of the first month. So we have 11 months that this basically existed. We made this at the end of the 7 months. So there's 5 months left in the year. So that is how we determine our 5 divided by 12, right? Same thing there. Oh, hey, that should be July, not January. All right. So here we are going to take our 48,000 and weight it. This is a process of weighted average, right? Same as process as any weighted average question. The costs were outstanding for this amount of period. The 36,000 were outstanding for 5 months. We get our weighted average, add them together. And if you've seen WAC, right? If you've seen BC, if you've seen weighted average shares outstanding in this exam yet, same process as those. And that's how you determine the weighted average accumulated expenditures for any of these capitalizing interest questions. All right, washer company, same thing as the previous example, had the following debt outstanding throughout year one. Well, we had 10% 2-year note specifically for the project, and then we had an 8% 5-year note. So this is other debt of 40,000. Keep in mind, why is it mentioning for the project versus other debt? Well, maybe this is just your credit card bill, and this is specifically for the project. So if it's for the project, that's important, right? That's important, and we're only going to capitalize if it's related to the project. Now, using the numbers from the loans before, we take our weighted average accumulated expenditures that we calculated. And remember, for this calculation, we're only using, for the avoidable interest, we're only calculating the 50,000 because that's the specific loan, right? For the actual equipment here. Okay, well, we take just simply the 5,000, right? The 5,000 from the specific loan, 10%, $5,000 of avoidable interest. However, what we also do is we take our weighted average accumulated expenditures minus that 50,000, and then we get $9,000, of which we take 8%, which that 8% is from the other loan, and that's 720 of avoidable interest. Because essentially what you're saying here is you could have refinanced, right? That's the whole point of what we're doing here. You could have refinanced and covered that, but this is avoidable interest. So together, this gets you 5,720 of avoidable interest. This is part of the process. It's going to take time. Run through it again, but you will get it. From here, we take that avoidable interest, right? Our avoidable interest was 5,720. The actual interest that we saw, this does include the non-related interest, right? So $50,000 at 10% is 5,000, 40,000 at 8%, 3,200. Together, we have actual interest of 8,200. Now we take the lesser here, which is 5,720, and we're going to capitalize the lesser of the avoidable or actual interest. So there we go. We capitalize this. Interest expense is the difference. So we talked about capitalizing versus expensing. The remaining 8,200 minus the avoidable, that gets expensed as interest expense. Just another accounting process. With time, it will come naturally to you.